Imagine waking up one morning and realizing that everything you've believed about wealth is a lie. That the books you've read, the advice you've followed, even the sacrifices you've made, all of it was operating inside a silent system you never saw. This isn't hyperbole. This is the reality most people never recognize. Wealth isn't created by hard work alone, or by luck, or even by intelligence. It is grown in silence, accelerated by invisible structures, governed by psychological levers that most never consciously pull. And yet, despite this, everyone is trying to catch up, trying to keep pace with a world that's moving on a hidden clock. Here's the trap. Society has taught you that financial freedom is a visible, measurable thing. You see the mansions, the cars, the Instagram posts, and your brain whispers, "That's success. I need that." But what it doesn't tell you is that this visible success is often a veneer, fragile, overstretched, and extremely vulnerable to collapse. Those flashing signs of wealth are controlled by a system designed to make you anxious, reactive, and easily distracted. The very things you chase most, the lifestyle upgrades, the status symbols, are the same levers that slow your wealth growth. This is why most people never escape. This is the hidden architecture. Consider this. In biology, a tree grows not by fighting the wind, but by bending with it, channeling energy towards structures that endure. In economics, the most successful capitalists don't chase every opportunity. They understand which systems amplify their resources silently over time. And in your personal financial ecosystem, a similar force exists. A quiet, almost invisible mechanism that compounds advantage for some while quietly eroding it for others. Most never see it. They operate on surface-level impulses, reactive behaviors, and outdated status cues. They live their entire lives thinking wealth is about effort, when in fact it's about alignment, with invisible systems that reward patience, leverage, and discretion. Silent anxiety grips nearly everyone because the system is always ahead. When you open your bank account, glance at your investments, or even scroll through social media, you're seeing signals. But here's the secret most never articulate. Signals are not reality. The signals you're chasing, new cars, bigger houses, flashy vacations, are illusions designed to trigger dopamine. They make you feel successful temporarily, while the quiet compounding engines of actual wealth tick by unnoticed. Imagine running on a treadmill that looks like a highway. You're moving, you're exerting energy, but your position relative to real progress is barely changing. That is the financial illusion most live under. And yet, there's a path few take. A path not dictated by society's applause, by viral validation, or by the constant noise of comparison. It is a path defined by silent habits, invisible alignments, and calculated decisions executed under the radar. It's not flashy. It's not intuitive. It requires resisting the lure of instant gratification and embracing the unseen mechanisms that control wealth flow. Those who understand this system don't just grow rich, they grow wealthy in a way that is nearly imperceptible to the outside world, but undeniable in effect. This is where the structure reveals itself. Wealth is not about chasing money. Wealth is about designing your environment, your habits, your decisions, so that the system works for you quietly, invisibly, relentlessly. The people who succeed are not the smartest. They are not the hardest workers. They are the architects of their own silent financial ecosystem. They understand triggers, thresholds, and the hidden laws that govern accumulation. And most importantly, they act when others are reacting. What I'm about to reveal isn't in your typical financial guide. It doesn't show up in flashy seminars or on influencer reels. These are habits so subtle, so counterintuitive, that ignoring them keeps most people stuck in a loop of anxious, reactive financial behavior for decades. But once understood, once internalized, these silent habits accelerate wealth growth in ways that compound far beyond ordinary effort. In the next few sections, we'll pull back the curtain. We'll expose the invisible architecture controlling your financial outcomes. You'll see how behavior, psychology, and mathematics converge in ways that most people never notice. And by the end, you'll understand not just how to earn money, but how to grow it silently, structurally, and exponentially. Here's the open loop. What if every decision you've made so far wasn't the problem, but every decision you will make could be the difference between stagnation and silent acceleration? What if, hidden beneath every impulse, every comparison, and every anxious financial thought, lies a system waiting for you to master it? This changes everything. The first silent habit of wealth begins not with money, but with perception. Most people approach finance as if it's a linear game. Earn more, spend less, save the rest. That is the trap. This framework assumes that your financial outcome is determined primarily by effort and self-control. But the truth is far more structural, far more invisible. There is an architecture underpinning your financial reality, a hidden design that dictates who accumulates wealth and who remains trapped in cycles of anxiety and scarcity. Understanding this architecture is the first cognitive shift, and it starts with a simple revelation. Money itself is neutral. It is behavior that multiplies or dissipates it. Imagine your financial life as a system of pipes. Each pipe represents a channel through which resources flow: income, expenses, investments, knowledge, and influence. Most people operate with leaky pipes. They earn, but impulsive spending siphons off growth. They save, but poorly allocated investments erode capital silently over time. They acquire knowledge, but it lacks applicability or connection to actionable leverage. The architecture of wealth is about plugging leaks, redirecting flow, and expanding the channels that multiply returns instead of merely holding them. This is invisible to the casual observer because the impact compounds slowly and silently, often invisible for years. Yet, this is the mechanism through which the wealthy operate daily. Now, consider the social context. Most people are wired to internalize financial shame. Mistakes are magnified, successes are minimized, and society continuously signals that money is a source of guilt, not power. Well, this is deliberate, not malicious, but structural. Systems, institutions, and cultural narratives teach reactive behavior. You're conditioned to spend to signal status, borrow to maintain appearance, and react emotionally to market swings. The first silent habit disrupts this conditioning. It is the habit of structural observation. You learn to see money not as a reflection of identity, but as a force in a system. You remove personal shame and replace it with systemic awareness. Once you detach emotionally, you can begin to manipulate the levers that others unknowingly surrender to circumstance. This is why the first cognitive shift is so powerful. It changes your frame entirely. Instead of asking, "How do I make more?" you start asking, "Which systems should I align with? And how do I allow them to work silently for me?" Here's an example. The wealthy rarely work harder for income alone. They identify leverage points, investment vehicles, business structures, skill networks that amplify effort. While the average person is reacting to opportunity, the financially aware are designing opportunity to react to them. This distinction is subtle but seismic in effect. Consider another dimension. Timing and compounding are invisible engines. Most people are obsessed with immediate results, salary raises, quarterly gains, or the next paycheck. But wealth growth is not about the sprint. It's about the structural curve. Capital deployed strategically compounds exponentially. A $10,000 mismanaged today can cost decades of potential growth. A $10,000 deployed correctly multiplies silently over years, is often outpacing the labor of someone earning 10 times as much. The key is understanding thresholds, flow, and alignment. Financial principles that operate independently of effort or popularity. This brings us to the paradox of knowledge versus action. People obsess over financial literacy, but fail to integrate insight into habitual execution. Knowledge without structural alignment is vanity. Action without awareness is friction. The first silent habit bridges this gap. It is the habit of observation, integration, and deliberate alignment. You observe the invisible architecture of finance, identify which levers create compounding growth, and restructure your life to allow these forces to act on your behalf. In doing so, you're no longer reactive. You're strategic. You're the architect of silent wealth acceleration. But here's where most stumble. Recognizing the architecture isn't enough. You must begin rewiring perception at a granular level. Every decision, no matter how small, feeds into this system. Buying a car, signing a subscription, or even how you spend leisure time. All these micro-decisions are either supporting the architecture or undermining it. This is why removing personal shame is critical. Once you stop blaming yourself for past missteps, you can examine these choices objectively and place them into a structural framework. Wealth is no longer about luck or talent. It is about flow, alignment, and consistency within an invisible, self-reinforcing system. The first silent habit also exposes a hidden truth. Most of what people fear financially is a manufactured scarcity. Scarcity isn't natural. It is amplified by behavioral triggers, or environmental pressures, and reactive conditioning. The wealthy exploit these triggers, not by chasing status, but by neutralizing them in their own behavior. They understand that anxiety is the opposite of leverage. It creates friction and leads to poor decisions. And this is the bridge to the next phase of wealth acceleration, understanding the behavioral traps that drain capital before it has a chance to grow. But before we step there, consider this. The architecture is invisible, yet omnipresent. Every dollar, every decision, every habit is a vector within a silent system. Your awareness of this architecture and your willingness to act within it is what separates stagnation from acceleration. And the moment you perceive this system clearly, you begin to move differently. Not harder, not louder, but strategically, quietly, and with compounding force. This is the trap most never see. And it's also the beginning of the silent path to wealth. Once you understand that wealth is a system, the next revelation hits hard. Most people are actively sabotaging themselves without realizing it. This is the domain of behavioral finance traps, a psychological web designed to extract value from predictable human impulses. Emotional spending, identity-based choices, and status illusions operate quietly, siphoning resources and momentum long before conscious thought even appears. Recognizing these traps is not optional. It is essential for silent wealth acceleration. Start with emotional spending. Every time you make a purchase driven by fear, desire, or social comparison, you're engaging a mechanism that financial psychologists call temporal myopia. You favor immediate gratification over long-term compounding. That new gadget, the designer bag, or the impulsive weekend trip feels rewarding in the moment, but costs you far more than dollars. It costs leverage, opportunity, and time. The pattern repeats itself across millions of micro-decisions, creating a slow bleed of potential wealth. And yet, this bleeding is invisible to most. They see the money leaving the account, but never recognize the structural impact of compounded opportunity cost. This is where the silent habits of wealth differ. They intercept these impulses before they manifest, replacing them with strategic patience and measured action. Next, consider identity-based financial self-sabotage. People often align spending and earning with who they think they are, or, more dangerously, who society tells them to be. If you are a successful professional, the cues dictate a luxury car, a high-status apartment, or visible signals of prosperity. These cues override rational decision-making because they are deeply tied to self-perception. The problem: self-identity rarely aligns with structural financial growth. When your spending defines your identity, you're constantly trading future leverage for present validation. It is a subtle, often unnoticed system of self-imposed friction that keeps wealth growth below potential. The first habit, structural observation, exposes this mismatch. Once you see the disconnect, you gain the clarity to decouple identity from impulse, opening space for deliberate, aligned choices. Status illusions are another silent predator. Humans are wired for comparison. It is hard-coded into our neural circuitry. You see someone else's success, and your brain interprets it as a benchmark for your own life. Social media amplifies this effect exponentially. The result: reactive spending, lifestyle inflation, and overextension. Many earn more, yet feel perpetually behind. The wealthy understand this pattern and consciously resist it. They leverage status not for performance, but as a tool for influence and access. They know visibility is optional. Leverage is mandatory. This cognitive distinction allows them to operate below the radar while their capital and influence grow quietly. Behavioral traps are amplified by environmental pressures. Peer groups, family expectations, and social norms create constant friction. Think of it like a fluid dynamics problem. The environment exerts pressure that shapes flow, often against your best interest. Most people react passively, succumbing to pressure rather than strategically redirecting it. The silent habit here is environmental engineering, structuring your surroundings to minimize triggers that encourage impulsive spending or irrational risk. Control over your financial environment is as crucial as control over income streams. Without it, even the best intentions fail because psychology, not logic, drives behavior under pressure. Cognitive fatigue further exacerbates these traps. Every day, humans face hundreds of decisions: what to eat, when to work, where to invest attention. Decision fatigue weakens self-control, leading to short-term choices with long-term consequences. Most financial failure is not dramatic. It is the accumulation of micro-decisions made under depleted cognitive resources. Wealthy individuals exploit this principle by creating routines and frameworks that reduce decision friction. Savings, investments, and spending become automated within a strategic architecture, minimizing the need for constant deliberation and protecting against the silent drain of fatigue. Here's the critical insight. These traps are invisible yet predictable. They follow patterns. Emotional spending spikes after stress. Status seeking escalates during social exposure. Decision fatigue peaks after intense cognitive load. Recognizing these patterns allows you to preemptively counteract them. The wealthy don't simply resist temptation. They engineer their system to prevent temptation from ever reaching the threshold of action. They intercept impulses, restructure identity signals, and automate aligned behavior. Some micro loops of behavior determine macro outcomes. Every impulsive purchase, every comparison, every reaction to social pressure compounds like interest in reverse, eroding wealth silently. But these loops can also be redirected. The second silent habit is about pattern recognition and preemptive intervention. You learn to observe triggers, model behavioral responses, and implement interventions before friction occurs. In doing so, you convert previously wasted impulses into aligned, wealth-generating actions. And here's the paradox. The traps that cripple most people are the same triggers that the wealthy exploit, only inverted. While the average person loses energy, attention, and capital to these patterns, the financially aware use them to enhance leverage, time arbitrage, and social influence. Like emotional intelligence becomes financial intelligence. Social comparison transforms into opportunity mapping. Status signals become strategic positioning rather than vanity display. Once you see the system, the levers reveal themselves, and you begin to operate within a structure that multiplies quietly yet relentlessly. But the full power of this insight is revealed when we start quantifying it, when we model compounding, thresholds, and wealth velocity mathematically. Understanding the traps conceptually is essential, but seeing how behavior translates into actual numbers is where the invisible system truly comes alive. And that is exactly what we will do in the next section. Exposing the hidden mathematics that accelerate, or decimate, wealth over time. Now that we've uncovered behavioral traps and invisible architectures, it's time to examine the mathematics that govern wealth acceleration. Because while psychology shapes behavior, math determines outcomes. Silent wealth is not a matter of luck. It's a function of compounding, thresholds, and velocity. And understanding these mechanics is where ordinary effort transforms into structural advantage. Compounding is deceptively simple, yet devastatingly powerful. Most people think of compounding as interest earned over time, a linear calculation. But in reality, compounding is a system that multiplies exponentially when applied strategically. Consider this. If you invest $10,000 at 10% annual growth, in 1 year you gain $1,000. After 5 years, you have $16,105. After 10 years, $25,937. The numbers themselves are not the revelation. The psychology is. Most people fail because they focus on immediate returns, but ignoring the silent multiplication over decades. The wealthy, on the other hand, internalize this principle and design systems that allow compounding to operate uninterrupted. Every dollar saved, every asset acquired, every skill leveraged is a vector in this exponential system. Capital thresholds are another critical concept. Wealth does not grow linearly across all scales. There are inflection points, thresholds, where incremental capital begins to generate disproportionate returns. For example, consider access to private investment opportunities. A $50,000 investment in the public market grows steadily, but a $500,000 allocation into exclusive venture capital or real estate syndication can yield returns 5 to 10 times higher due to leverage, insider access, and structural asymmetry. Most people never reach these thresholds because they are caught in consumption loops. The first silent habits, structural observation and behavioral interception, are the only way to reach these levels without catastrophic risk. Velocity of wealth compounds the effect even further. Wealth grows fastest, not just when you have more money, but when capital is deployed with timing, leverage, and strategic windows in mind. Imagine two individuals. One earns $100,000 a year and spends $90,000, saving $10,000. The other earns $50,000 but invests $30,000 strategically. Over time, the second individual can surpass the first in net assets because velocity, the rate at which capital is converted into growth, exponentially outpaces raw income. Wealth is a dynamic system. Income is a static metric. Understanding and controlling velocity is a hallmark of the silent acceleration habit. Let's break it down numerically. Suppose an asset grows at 12% annually. A $50,000 investment today becomes $158,000 in 10 years. But if you reinvest additional capital annually, say $10,000 each year, the growth skyrockets to $296,000. This is the hidden power of strategic reinvestment. The combination of compounding principle and incremental additions creates an almost unstoppable trajectory. Yet, behavioral traps often prevent this reinvestment. Impulses, fear, and perceived scarcity siphon away capital, leaving people with far less than potential. The system rewards patience, structure, and disciplined capital allocation. Escalation also occurs when you combine multiple compounding vectors. Skills, social networks, and influence all compound alongside money. For example, acquiring a high-demand skill increases income potential. That income, when invested, compounds. Meanwhile, social influence can open access to exclusive investment deals, further amplifying growth. This multidimensional compounding is the secret few ever understand. It is why some individuals, starting with far less, surpass their peers who earn more but fail to align their psychological, financial, and social systems. Consider the concept of asymmetry. Not all opportunities are equal. A single strategic allocation of capital can outperform dozens of smaller, reactive decisions. For instance, an entrepreneur investing in a high-potential startup that grows tenfold in 5 years achieves the same result that would require decades of incremental savings in the stock market. Asymmetry is the silent multiplier of wealth, and recognizing it requires a cognitive shift, seeing beyond effort and focusing on leverage. Most people see effort as the currency of growth. The wealthy see leverage. Wealth velocity also interacts with thresholds to create cascades of advantage. Crossing a critical capital threshold can unlock access to better deals, superior knowledge, and higher quality networks. These are structural accelerators that compound over time. Think of it as moving from a bicycle to a sports car. The infrastructure exists, but until you reach the threshold, you cannot exploit it. Silent habits are what build the momentum to reach and sustain these thresholds, and the math ensures that once you do, growth accelerates almost autonomously. Finally, escalation frameworks show why incremental improvements matter. A 1% improvement in capital efficiency compounded across multiple vectors, savings rate, investment selection, skill acquisition, and network leverage, can translate to exponential results over decades. Most people underestimate small decisions because they are unaware of the multiplicative effect across systems. The silent habit is recognizing that every micro-decision, every purchase, every skill learned, every network nurtured, feeds the compounding system. Over time, these seemingly minor choices define whether wealth grows or stagnates. This is where clarity transforms into power. Understanding the mathematics of compounding, velocity, and asymmetry doesn't just illuminate potential, it creates agency. It allows you to see which levers matter, where to allocate attention, and how to navigate the hidden architecture of wealth. Shall you begin to think in decades, not months? Thresholds, leverage points, and velocity curves cease to be abstract. They become actionable vectors in a system that responds to strategic alignment. But even with all this knowledge, intelligent individuals still fail. They grasp compounding, thresholds, and asymmetry. But social programming, lifestyle inflation, and environmental pressure erode their advantage. This is where the next section takes over: why intellect alone cannot escape structural failure, and how external forces manipulate even the brightest minds into financial stagnation. Understanding compounding and wealth velocity is essential, but intelligence alone does not guarantee financial success. In fact, some of the smartest, the most capable individuals still fail, often spectacularly, because they underestimate the influence of social programming, lifestyle inflation, and environmental pressure. These are forces external to skill and knowledge, yet they operate with relentless precision, shaping decisions in ways most never notice. Social programming begins early. From childhood, we are conditioned to link identity with consumption and status. Society rewards visible markers of success: cars, clothing, houses, gadgets, while often ignoring silent wealth accumulation. This creates a cognitive bias, the assumption that wealth is measured by display rather than by systems, compounding, or leverage. Even the most intelligent individuals, trained to optimize, fall prey to this invisible programming. They make decisions that feel rational, but are in reality dictated by social expectations rather than structural advantage. Their financial behavior becomes reactive, a response to perceived social pressure rather than long-term strategic alignment. Lifestyle inflation is another silent predator. As income increases, spending tends to follow, not proportionally, but exponentially. Humans are wired to normalize expenditure relative to perceived success. A raise or promotion often triggers purchases that increase obligations: bigger mortgages, faster cars, frequent luxury experiences. The trap is subtle. While income rises, net capital does not. It often stagnates or even declines relative to opportunity cost. Wealthy individuals consciously resist this pattern by separating income from lifestyle. They delay gratification, reinvest incremental gains, and cultivate a mindset that prioritizes leverage over visible consumption. Environmental pressure compounds these effects. Peer groups, family expectations, and cultural norms constantly signal what is appropriate behavior. A friend's vacation, a colleague's new car, or a family member's lifestyle can trigger comparison-based decision-making. This is not a matter of moral failing. It is a structural reality of human psychology. The environment exerts pressure that shapes behavior, subtly directing resources away from compounding and leverage toward consumption and validation. Only by engineering one's environment, controlling exposure, setting boundaries, and creating frictionless systems for aligned behavior can these pressures be neutralized. Decision fatigue exacerbates the problem. Every day, Mamunuans face hundreds of financial micro-decisions. Cognitive resources deplete rapidly under constant decision-making, leading to impulsive spending, procrastination, or poor investment choices. The intelligent individual may understand principles in theory, but fail in practice when cognitive energy is low. This is why the habit of automation and structural alignment is so crucial. By removing friction from wealth-supporting decisions, automating savings, investments, and skill-building routines, you preserve cognitive bandwidth for high-impact, strategic choices rather than reactive behavior. Even knowledge without discipline fails in these contexts. Individuals who understand compounding, leverage, and behavioral traps may still falter if they succumb to social pressure, lifestyle inflation, or cognitive overload. As intelligence amplifies opportunity, but does not insulate against psychological and environmental forces. This is why silent habits matter. They are the scaffolding that ensures mathematical advantage is realized in reality, not just in theory. Consider the economics of lifestyle inflation numerically. Imagine someone earning $100,000 annually and spending $85,000. After a raise to $150,000, their spending rises to $130,000. Despite a substantial increase in income, net savings only improve marginally. Over a decade, this subtle pattern erodes potential compounding by hundreds of thousands, if not millions. Meanwhile, a peer earning less but controlling lifestyle, avoiding pressure-induced spending, and reinvesting strategically achieves exponential growth. Social pressure and behavioral programming are invisible, but their impact is quantifiable. Intelligent people also underestimate signaling and cognitive bias. They assume rationality governs most financial decisions. In reality, human behavior is predictably irrational. Status signaling, herd influence, and loss aversion dominate. Recognizing these patterns is essential for wealth growth. It is not enough to know math or strategy. One must integrate psychological insight into daily habits. Silent habits do precisely this. They create alignment between rational understanding and habitual execution. At the intersection of social programming, lifestyle inflation, environmental pressure, and decision fatigue lies the structural failure point for most people. This is where the wealthy diverge. They design systems to operate autonomously, bypassing reactive triggers entirely. The environment is sculpted to support compounding, leverage, and strategic patience. Habits become self-reinforcing. Behavior aligns with long-term goals without continuous conscious effort. This is the invisible architecture in action. But here's the critical insight. Intelligence and effort alone are insufficient. Without structural alignment, behavioral control, and environmental engineering, every micro-decision risks erosion of capital and compounding potential. The next phase reveals the framework for strategically building a wealth blueprint, an architecture designed not just to resist these pressures, but to exploit them subtly for acceleration. Now that we've dissected behavioral traps, compounding, velocity, and environmental pressures, it's time to construct the strategic wealth blueprint. This is the framework that turns knowledge into action, psychology into structure, and opportunity into silent acceleration. The blueprint is not a generic roadmap. It is a system of leverage, thresholds, and alignment that allows capital, skills, and networks to compound harmoniously. At the foundation lies capital structure. Wealth is not about how much you earn. It is about how your resources are organized. Think in layers: liquid capital for immediate opportunity, semi-liquid assets for growth, and illiquid high-leverage investments for structural advantage. Liquid capital, cash reserves, is the frictionless fuel that allows you to exploit windows of opportunity without disruption. Semi-liquid assets, stocks, ETFs, income-generating portfolios provide steady compounding while maintaining flexibility. Illiquid, a high-leverage investments, real estate syndications, private equity, or strategic business stakes, offer exponential growth potential but require threshold capital and careful risk management. The blueprint dictates balance between these layers, ensuring stability while maximizing acceleration potential. Next is asset acquisition logic. This is not about buying what you like or even what seems profitable superficially. It's about systems thinking. Each asset must serve multiple vectors simultaneously. Does it generate cash flow? Does it compound in value? Does it offer optionality for future leverage? The wealthy prioritize assets that tick multiple boxes, transforming capital into a multi-dimensional growth engine. For example, a rental property does more than provide monthly income. It accrues appreciation, provides tax advantages, and can serve as leverage for future acquisitions. The blueprint ensures that every acquisition multiplies structural advantage rather than merely increasing surface-level wealth. Risk mitigation is the next critical pillar. Most failures occur not from lack of knowledge or effort, but from misaligned exposure. The blueprint structures risk deliberately, differentiating between strategic risk and impulsive risk. Strategic risk, measured, diversified, and threshold-aware, creates asymmetric upside without threatening core stability. Impulsive risk, over-leveraging, chasing trends, or reacting emotionally, erodes compounding silently. Building the habit of risk calibration is a cornerstone of silent wealth. It allows you to act decisively while remaining insulated from external shocks, preserving the architecture for long-term growth. The skill stacking is another silent multiplier. Wealth is not purely financial. It is a function of knowledge, influence, and capability. The blueprint integrates skill acquisition into the architecture. Each skill is selected for leverage potential. Negotiation enhances deal flow. Analytical ability optimizes investment decisions. Leadership amplifies business scaling. And network building exponentially expands opportunity access. Skills, like capital, compound over time. By consciously stacking them in alignment with financial architecture, you create a self-reinforcing system that accelerates wealth quietly but relentlessly. Cash flow architecture is equally vital. Most people confuse income with wealth. True wealth is the structured conversion of effort, assets, and skills into recurring cash flow that feeds further compounding. The blueprint emphasizes creating multiple parallel streams: active income, semi-passive revenue, and fully passive cash flows. Each layer reinforces the others. Income becomes a lever for asset acquisition. Assets generate reinvestable capital, and cash flow maintains optionality. Over time, these layers interact multiplicatively, forming a financial ecosystem where capital growth is autonomous, predictable, and invisible to casual observers. Long-term asymmetry thinking is the final pillar. The wealthy operate in decades, not quarters. They understand that the compounding system is not linear. Thresholds unlock disproportionate returns. Early patience and disciplined execution create asymmetric advantage over competitors locked in reactive cycles. The blueprint instills this mindset. We're ensuring that every decision prioritizes structural leverage, velocity, and compounding over surface-level visibility or immediate gratification. Every dollar, every skill, every connection is evaluated for potential asymmetry. The ability to generate exponential returns with minimal proportional input. The strategic wealth blueprint is not static, it is adaptive. Markets change, opportunities shift, and human behavior evolves. But the underlying architecture remains consistent. Liquid capital, multidimensional assets, risk calibration, skill stacking, cash flow alignment, and asymmetry thinking form a system that functions across environments. The wealthy don't merely survive external change, they exploit it, because their blueprint is resilient, flexible, and systematically aligned. Here is the open loop. The blueprint alone establishes structure, but acceleration requires integration of dual engines, income and assets, and mastery of timing, leverage, and optionality. Without this phase, structure exists, but velocity remains untapped. The next section will reveal the mechanics of the acceleration phase. where silent systems shift from slow growth to exponential momentum, and wealth begins to compound at speeds that defy intuition. The strategic wealth blueprint lays the foundation, but structure alone is inertia. Acceleration requires activating dual engines, income and assets, simultaneously, creating velocity that compounds exponentially. This is where silent wealth shifts from linear growth into exponential momentum, where timing, leverage, and optionality intersect to multiply results in ways the uninitiated never perceive. The first engine is income, not merely salary or transactional revenue, but strategically diversified streams that scale with minimal incremental effort. Consider consulting, royalties, side ventures, or digital products. These streams provide cash flow that fuels reinvestment without disrupting your core capital. The wealthy structure income to feed the system, not just to consume. The invisible principle: income must amplify assets, not lifestyle. Without this, velocity remains constrained, no matter how intelligent or disciplined you are. The second engine is assets, capital that compounds, generates cash flow, or creates optionality functions as a silent growth machine. Unlike income, which requires effort, assets work autonomously. Stocks are real estate, intellectual property, and strategic business stakes accumulate value while you focus elsewhere. Acceleration is achieved when both engines, active income and autonomous assets, operate in concert, each feeding the other. This dual system is why the wealthy rarely rely on a single source. Reliance creates fragility, while multiplicity compounds leverage. Optionality is a critical lever within this phase. Every asset and skill should serve as a potential pivot point. Optionality allows you to act when opportunities emerge while minimizing downside exposure. For example, a business skill may not generate immediate revenue, but unlocks future partnerships or investment access. Similarly, holding cash reserves enables strategic deployment during market dips. The wealthy do not chase every opportunity. They position themselves where optionality intersects with structural advantage, ensuring maximum upside while limiting risk. Leverage is where many accelerate, and many destroy themselves. The distinction is in control versus abuse. Controlled leverage multiplies capital without creating existential risk. Real estate mortgages, margin investing, and business financing are examples when applied judiciously. Each dollar borrowed amplifies growth, but thresholds and risk management protect core structure. Abuse occurs when leverage is reactive, poorly timed, or emotionally driven. Silent wealth acceleration is not about risk avoidance, it is about risk mastery. Every move is intentional, measured, and threshold aware. Strategic timing is the final engine. Wealth acceleration is not uniform, yet it is episodic, with windows of compounding opportunity. Markets fluctuate, industries evolve, and behavioral patterns shift. Those who can identify timing windows and deploy capital or skills precisely achieve outsized growth. The wealthy understand that patience is a weapon, action is a tool. They wait for conditions to align, then act decisively, allowing structural advantage to convert into exponential results. Timing is invisible to the casual observer, but it is often the difference between mediocre growth and compounding mastery. Consider a scenario. An individual earns $200,000 annually and invests 50% into passive index funds. Over 20 years, compounding yields impressive growth. Another individual earns $150,000 but strategically invests in asymmetric opportunities, leverages skills for scalable business ventures, and maintains cash reserves for precise market entries. The second individual can outperform the first by multiples despite lower initial income. The difference is acceleration, dual engines, optionality, controlled leverage, and timing. These forces multiply silently, invisibly, and relentlessly. The psychological overlay cannot be ignored. Acceleration requires emotional discipline, delayed gratification, cognitive patience, and detachment from status-driven impulses. Without this, the engines sputter. Temptation, envy, or reactive behavior interrupts compounding. The wealthy internalize this, creating cognitive frameworks and environmental design that protect acceleration. Habits, routines, and thresholds are engineered to minimize friction, prevent diversion, and ensure that capital, skill, and opportunity move unobstructed toward growth. This phase also creates feedback loops. As assets grow and income streams expand, new opportunities emerge automatically. Access to private deals, strategic partnerships, and leverage thresholds are unlocked. Capital and opportunity begin to compound independently of daily effort. Silent wealth accelerates because the system is self-reinforcing. Each advantage generates the next, and velocity compounds upon itself. The open loop remains. Acceleration creates growth, but long-term dominance requires identity evolution. Without rewiring psychology to think in decades, maintain discipline under exponential influence, and internalize delayed gratification, the system can be undermined from within. The next section will reveal how internal transformation solidifies external acceleration, turning temporary momentum into lifelong wealth mastery. Acceleration without psychological transformation is unstable. You can build dual engines, leverage compounding, and exploit timing windows. But without an internal shift, the system will eventually break under pressure. Identity evolution is the silent habit that converts velocity into sustained wealth mastery. It is the process of rewiring cognition, emotion, and perception to operate on structural timelines rather than reactive impulses. This is where delayed gratification becomes instinctive, not forced. The first component is delayed gratification rewiring. Most people think in months, quarters, or the next bonus. The wealthy think in decades. They internalize the exponential effects of compounding and structural alignment, allowing them to make choices that appear conservative in the short term, but generate outsized results over time. This mindset shift is not optional. It is foundational. It creates a cognitive buffer against emotional impulses, social pressure, and status-driven distractions. Every decision is filtered through a long-term lens, ensuring alignment with structural advantage rather than fleeting validation. Strategic detachment is the second pillar. The ability to separate identity from consumption, status, and peer influence is critical. Silent wealth requires operating below the radar, where visible recognition is unnecessary. Detachment is not indifference, it is clarity. It allows the wealthy to pursue opportunity without distraction, so to act decisively without being swayed by comparison or social expectation. This internal framework reduces reactive behavior, prevents lifestyle inflation, and protects compounding systems from unnecessary friction. Thinking in decades, not months, is a behavioral revolution. This temporal expansion creates psychological asymmetry. The immediate becomes less significant, while structural alignment takes precedence. People who fail to evolve remain trapped in short-term cycles, reacting to social signals, chasing instant gratification, and measuring success by comparison. Wealth is ephemeral without perspective. Identity evolution rewires perception, allowing delayed but powerful feedback loops to dominate behavior. The system begins to self-reinforce because choices are consistently aligned with long-term structural advantage. The third layer is emotional discipline under growth pressure. Acceleration magnifies internal and external stressors. As capital, opportunity, and optionality expand, the mind experiences amplified anxiety, decision fatigue, and social friction. Identity evolution equips you to navigate this pressure with composure. Strategic mental frameworks, habits, and cognitive architecture prevent overreaction. Decisions are not clouded by fear, greed, or ego. They are calibrated to system alignment. Emotional resilience is not a byproduct. It is a habit actively cultivated through self-awareness and structured reinforcement. This phase also transforms perception of risk and opportunity. Early in wealth accumulation, fear dominates. Fear of loss, scarcity, or making the wrong move. Identity evolution reframes these impulses. Risk is quantified structurally, opportunity is evaluated asymmetrically, and emotion is reserved for clarity rather than reaction. The wealthy do not avoid risk. They understand and integrate it, creating controlled exposure that multiplies growth potential. This psychological recalibration amplifies every decision, turning previously dangerous impulses into system-aligned advantage. A subtle but critical shift occurs in social cognition. As identity evolves, alignment with networks, communities, and mentorship shifts from superficial affiliation to strategic partnership. The wealthy surround themselves with individuals who reinforce long-term thinking, provide access to asymmetrical opportunities, and normalize delayed gratification. Social architecture becomes a silent accelerator, reinforcing internal evolution while protecting against behavioral traps. Networks compound influence, knowledge, and optionality, feeding directly into the structural system of wealth. Finally, identity evolution is recursive. As internal frameworks solidify, external behaviors align, which reinforces internal perception. Patience becomes habitual, detachment becomes natural, and structural thinking becomes instinctive. By integrating mindset, behavior, and environment, wealth growth becomes not just sustainable, but inevitable. The open loop remains. The structural system, dual engines, and identity evolution converge. But true mastery requires redefining what wealth, freedom, and power mean beyond mere accumulation. That is the next frontier. By the time identity evolution is internalized, you begin to see wealth differently. The traditional markers, salary, assets, status symbols, become superficial metrics. True wealth is no longer a number in a bank account. It is a systemic reality, a dynamic interplay of freedom, influence, and structural power that compounds silently. Redefining wealth is not an abstract exercise. It is a practical shift that transforms every decision, habit, and relationship. First, wealth transcends income. Most people equate earning more with being wealthier. This is the cognitive trap that fuels endless striving with minimal structural effect. Income is merely a tool. It is the fuel that feeds the engines of assets, leverage, and optionality. True wealth is the capital you control, the systems you align with, and the asymmetry you exploit. It is measurable not by what comes in, but by what multiplies autonomously while you focus on structural growth. Viewing wealth this way allows patience, reduces stress, and creates strategic clarity. Second, freedom redefines itself beyond consumption. The wealthy do not seek freedom to spend endlessly. They seek freedom to choose alignment. Freedom is the ability to act decisively, to deploy resources at strategic moments, and to avoid reactionary cycles dictated by social pressure or cognitive bias. It is the capacity to pause, observe, and intervene in the system rather than be consumed by it. Lifestyle, luxuries, and status indicators are byproducts, not the objective. This shift changes behavior fundamentally. It reduces impulsive spending, anchors identity in structural agency, and transforms patience from discipline into instinct. The power is the final axis of redefinition. Social and financial power is not about visibility or dominance. It is about leverage. It is the ability to influence outcomes silently, create access to opportunities others cannot see, and extract exponential advantage from seemingly ordinary resources. The wealthy operate under the radar precisely because true power rarely needs display. It manifests in structural decisions, network positioning, and asymmetrical deployment of capital and skills. Visibility is optional. Leverage is mandatory. This principle changes how every decision is evaluated. Each action is assessed for structural impact rather than performative effect. Redefinition also reframes risk and failure. In traditional thinking, risk is avoided and failure is feared. Under this system, risk is measured, controlled, and leveraged for asymmetric outcomes. Failure becomes feedback, not shame. Capital, opportunity, and skills are deployed iteratively, refined through systemic learning loops. By redefining these metrics, every action becomes an input into compounding systems rather than a source of anxiety. The fear that stifled growth is replaced by clarity, agency, and strategic confidence. Time itself becomes the currency of redefinition. Whereas most operate in quarters, months, or weeks, wealth redefined operates in decades. Decisions are evaluated on cumulative impact, velocity, and leverage rather than immediate reward. The system allows for silent accumulation while others chase visibility, creating a gap that grows exponentially. Delayed gratification is no longer discipline. It is the natural alignment of behavior with structural advantage. Patience is power. Alignment is freedom. Optionality is leverage. Redefinition also transforms social cognition. Relationships, mentorships, and partnerships are evaluated for strategic complementarity rather than status reflection. Networks are intentionally curated to reinforce long-term structural advantage. Emotional intelligence, negotiation skills, and influence compound alongside capital. The system is recursive. Internal clarity drives external alignment, which feeds further internal evolution, creating a self-sustaining ecosystem of wealth, freedom, and power. Here is the hidden truth. Wealth redefined is invisible to the masses precisely because it does not need validation. While others measure themselves by flashy displays and social signals, the silently wealthy move through life accumulating leverage, velocity, and compounding advantage. This is why so few escape cycles of superficial success. They are evaluating wealth with the wrong metrics. The wealthy see the system. They align with it. They multiply quietly, persistently, and exponentially. And here's the final open loop. Now that you understand the invisible systems, dual engines, identity evolution, and redefinition of wealth, the next and final step is action. Knowledge without execution remains theory. It is time to convert this entire framework into practice, to challenge your present self, and to ascend into a reality where silent acceleration is no longer an aspiration, but an inevitability. Everything you've seen so far, the invisible architecture, the behavioral traps, compounding velocity, dual engines, identity evolution, and wealth redefinition, culminates here. Though this is where theory becomes action, potential becomes momentum, and silent systems transform into a lived reality. The question now is not what you know, but what will you do? The challenge is simple, yet unforgiving. Every habit, Every decision, every impulse must be evaluated through the lens of structural alignment. Will this choice compound advantage, or will it bleed opportunity? Will it amplify velocity or disrupt momentum? For decades, most people operate without this question, reacting to anxiety, social pressure, and impulsive desire. Those who master it think decades ahead, act with precision, and allow the system to do the work that effort alone cannot achieve. Visualize your future self, a person who understands every lever, every threshold, every vector of growth. Your income streams are aligned with compounding assets. Risk is measured, optionality is maximized, and decisions are filtered through decades-long perspective. Status and consumption no longer dictate behavior. Freedom, leverage, and structural advantage do. Your mental architecture is resilient. Your environment is engineered. Your identity is evolved. You're no longer at the mercy of reactive cycles or social programming. You are the architect of your own silent acceleration. This is the moment of ascension. Execution is your bridge from knowledge to structural reality. You must act consistently and deliberately within the systems we've revealed. Begin by auditing every habit, every financial vector, and every decision. Remove what disrupts compounding. Amplify what multiplies advantage. Align income, assets, and skills with thresholds that generate exponential growth. Curate networks. Engineer environments and rewire perception to operate in decades, not quarters. This is not incremental improvement. It is systemized transformation. Here is the irrevocable truth. Silent wealth is not about luck, effort, or visibility. It is about alignment. Every choice you make either strengthens the system or erodes it. The open loop is yours to close. The architecture is in place. The habits are revealed. The identity framework exists. Your execution is the only variable left between stagnation and exponential compounding. So act, align, accelerate. Let every decision, every investment, every moment of patience compound. The invisible system rewards those who master it and bypasses those who ignore it. This is your structural battlefield. This is your asymmetry. So this is the silent acceleration that transforms ordinary lives into enduring wealth. And remember, the world will never see your progress the way you do. But that is the point. Silent compounding is invisible, relentless, and unstoppable. Master it, and nothing in life will move faster than your quietly accruing advantage. One final line to anchor everything. Wealth is not what you earn, but how silently, structurally, and relentlessly you let the system work for you.